Okay, so the recording has started. So good evening, everybody. Our topic for tonight is financial instruments. So there are three standards that deals with financial instruments. Number one is IES 32, which deals with presentation of financial instruments. This IES 32, sorry. Um, I don't remember if I said IFRS 32. It is IES 32, presentation of financial instrument. So it is with definitions and classification of financial instrument. Then we have IES 39. So IES 39 has been scrapped. So there is no more IES 39 again. There is now IFRS 9. Just like if you remember our list, the former list standard is IES 17. But the new list standard is IFRS 16. Then revenue, too, if you remember, our revenue standard before was IES 18. Then the new standard is IFRS 15. So IFRS 9, it deals with measurement of financial instruments. Why we have IFRS 7 too. IFRS 7 deals with disclosure of financial instruments, which deals with just major disclosures. So IFRS 9, so let's start financial instrument. So what do we regard as financial instrument? So as you all know that I like lecturing from the scratch so that at least we know what we are saying before we move on to this big grammar. So let me try to break it down. As we all know that in our statement of financial position, we have the debit side and the credit side, right? We have the asset side, then we have liability and equity side. When we add our equity and liability together, it will balance, it will be equal to the total assets, right? Yes. So in our asset section, we have the current assets and the non-current assets, right? Yes. So that is the classification, the first classification I would like to tell everybody today. The major, like traditional classification of assets is current assets and non-current assets. And what is the difference between the two? IS1 defines current assets. IS1 defines current assets as assets that is expected to be realized within 1 year. That is expected, although sometimes it's not applicable, but it is expected to be realized between 1 year. And that is why we have receivable, we have bank balance, we have cash, we have short-term investment in the current asset. We have prepayment, right? We have prepayment, we have contract assets under the current asset section. Then we have non-current asset section. So which are what? Which are in line with IS1, non-current asset is asset that is not current asset. That means any other asset that can be realized for more than one accounting year. And that is where we have tangible assets, which are PPE, investment property, and the likes. So they are assets uh, that can be used for more than one accounting year. If you remember a 16 definition of PPE, so that is it. So where I'm going is that we have current assets and non-current assets. Then we have financial assets and non-financial assets. So that is where we are going today. When we talk about assets, we talk about non-financial assets and financial assets. So now that is where we are going. When we are now talking about financial assets, we can now talk of financial instrument. So what is financial instrument? It's any contract. Financial instrument is it must be a contract that gives right to both a financial asset to a party, then financial liability or equity instrument to another party. So for a financial instrument to exist, it must exist between two parties. One, to me, it must be a financial asset. Then the other party will be a financial liability or equity instrument. So A good example of financial instrument is what? Bank balance. So when I deposit my money in the bank, in my hand, it is a financial asset because I have cash. Anytime I need money, I will go to bank, abi? Yes. Then to the bank, it is a financial liability. So if you are working as an accountant in a bank, if you are an accountant in a bank, when a customer deposit money, that money is a liability in the bank account. In the banks, let's say First Bank now, in First Bank financial statement, that money you deposit is a liability. You are not the owner. But in my own hand, it is an asset, it is a financial asset because it is money that if I need it tomorrow, I'll go and withdraw it. Abi? So that is financial instrument. It gives rise to assets, to financial asset to one party and equity or liability to another party. Another good example of financial instrument is equity investment. And what is equity investment? It is shares. When I buy shares in, let's say, First Bank, do you know that when I buy shares in First Bank, in my hand, it is a financial asset. But in the bank hand, on their own part, it is an equity instrument. And what is the difference between financial liability and equity instrument? The difference is just very simple. When you have a financial liability, you are going to collect your money back. But equity instrument, you cannot collect your money back. You are a shareholder. You now have an interest. An interest. We can either be a controlling interest or non-controlling interest. If you remember our group account. So when you have 20% investment, they call it ordinary investment, right? But when you have above 20% to 49% or 50%, we call it associate. Then when you have above 51%, we say you have a controlling interest. That means you are now a parent company. Should we remember very well? So that is financial instrument. So talking about financial instruments, please, before we move on, are we fine with that introduction? Do we have idea of financial instrument now? Mr. Folashade, Mr. Adeola.
Yes, I'm fine with the explanation. Though I'm always like, what is this financial instrument going on? But I think with your explanation is clear.
All right, all
Thank
right.
you.
Thank you, man. Thank you. Mr. Adeola, how far?
I'm okay with it.
All right, all right. So now we can go. Once you can understand that financial instrument, I think when we move further now, it will be very because there are so many people, even when I started my skill level, then when my lecturer explained, I would love be looking at what is this financials. But once you understand it, then the calculation will be very easy for us. Now let's move financial assets. What is financial asset? Financial asset, this is the definition according to the standard. They said these are assets that are cash. So when you have a cash or bank balance, when you have a cash or a bank balance, it is a financial asset. That is a financial asset. When we have cash, then when we have bank balance, let me quickly do bank balance. That is a financial asset. Now, contractual rights to receive cash or another financial asset of another party. That means when you have a right, if you remember when we are talking about PPE, the recognition criteria. What is the recognition criteria? Now, one, it must be probable that future economic benefits will flow to the entity, abi? So when we are talking about those recognition criteria, that means you have a right to receive cash or another financial asset of another entity. So what are we saying? Do you know that when you invest in another company, let's say equity instrument, let's say equity instrument. Now, when you invest in, let me put EG here, EG, equity instruments. When you invest in another company, do you know that you have a right that at the every financial year you have a right of dividend? Although that right is not that right is not very 100% right, because once a company has a loss and when the company does not have a reserve, that means when they do not have a retained earnings, they cannot give you dividend. But with that investment that you bought, you have a right, and that is what they are saying, contractual right. You have a right to receive cash or another financial asset from another entity. That means with that equity instrument you have, you can sell it. When you sell it, then you can collect cash. Then if you like, you can exchange it with your equity instrument. Example is equity instrument in First Bank. Now I have an equity investment in First Bank. Fine, it is a financial asset in my book. Now I now have another person, Mrs. Afalashade. She has equity investment in Zenith Bank. Me, I have in First Bank. She has in Zenith Bank. She's now angry with people in Zenith Bank. I don't like all these Zenith banks. I don't like them. Please, I will sell it. She now contact me that Mr. Taufik, I want to sell this my shares in Zenith, but I don't like them at all. I don't like them. They are just irritating me. I now asked her that, where do you now want to invest? She now told me that First Bank. And I say, me, I have a shares in First Bank. Me too, I don't like First Bank. In fact, I hate them. Example, I'm just saying example that I don't like First Bank. Okay, then me too go. I'm preparing to invest in Zenith Bank. We can exchange our financial assets. And what is financial asset? It is a contract. When you buy an asset, when you buy a financial asset, which is shares, they are going to give you uh, a share certificate, like just like a document. So we exchange it. We sign a contract that me, I will collect Zenith, you will collect First Bank, and that is all. And that is what this point number 2 is saying. It is a contractual right to receive financial asset of another entity. You can exchange it. It is your right. You have that right since you have that shares. So hope we agree with that. Now the next one, contractual right to equity instrument of another party, which is somehow the same thing as the first one. You can sell that shares, which is an equity instrument, then to collect another one, you can exchange it with another person. It is your right. You have it. Then a contractual right to exchange financial assets or a liability under the condition that is potentially favorable. And that is what I was explaining. When you exchange it and it is favorable to you, you can exchange it. And that is the definition of financial assets. This is the definition of financial assets in line with the standard. In line with the standard, this is the definition of financial assets. So let's move on. Let's move on. Now, example of financial asset. Just like I said it earlier, I said example of financial asset. Number one is trade receivable. What is trade receivable? It is, if you remember, trade receivable in IFRS 15. It's IFRS 15 that defines trade receivable. It is a right to receive cash, right? It is a right to receive cash in the future after you have done what? After you have satisfied a performance obligation that is conditional, that is not conditional. That means you don't have a condition. If you remember our IFRS 15, and that is the problem of standard. The standard is too much. So if you are not reading constantly, you'll be forgetting them. So IFRS 15 define trade receivable and contract assets. Contract assets and trade receivable are very, very similar. Contract assets, it is conditioned on something. While trade receivable, it is not conditioned on something. If you go back to IFRS 15, you remember what I said about that. Then we have bank balance, we have cash deposits, then we have investment in equity instrument of another entity. So when I invest in equity instrument of another entity, it is a financial asset. It is a financial asset. Then investment in debt instrument. Can we see the difference? One is equity instrument, two is debt instrument. And to make it very easy, let me put it here. E.g., shares. Let me put it here. Because when we start solving question now, this is what usually cause problem in financial instrument. E.g., shares, shares in XYZ Limited. Investments in shares in XYZ Limited. So this is an example of equity instrument of another entity. As a company, Taufik PLC, I now invest in shares in XYZ. So it is an equity instrument of another entity. So in my account is a financial asset. Then a good example is this. Let me do copy and paste so that we are going to be very fast or short. Okay. This will be investments in bond. A good example of this one is investment in bond. Investment in bond. So bond is a financial asset. However, it is an investment, it is a debt instrument. And I know we remember very well the difference between equity instrument and debt instrument. Can you give, do we have time? Let me ask. Mr. Palashade, Miss Adiola, can you, can anybody give me the difference between equity instrument and debt instrument? Because when we start solving, it is going to give us there's going to be a question mark. So let me see. Let me see. Yeah, I'm listening, ma.
Okay, Mr. Taufik, I think you've differentiated it already, or is there anything I'm missing? Equity
There's something we
instruments
are,
are shares,
yes,
while debt instruments are bonds.
yes. What is the
So,
difference? What is the difference between the two? There is difference. So,
okay, ah, equity is equity now. Your
mm,
shares are traded on the, as in, I don't know, what's the difference?
okay, just
Okay,
look at it. Yes,
the bond can be redeemable. I don't know
yes,
if
yes,
I'm
you are right.
correct, yeah.
You are correct. It can be redeemable and irredeemable. Yes, you are correct.
Irredeemable. Okay.
Yes, yes, we are correct.
Is that
So
the
any other
difference?
thing, that's it. No, okay, that's what you want. I want to hear your say first, man. Let me hear your say before I can now talk.
Eh, I've said it already now. That
All right.
okay. I know it too, but I don't even know how to put it down, Sha.
Yeah, put it,
But I
because
know
it is very important in this, and that is the reason why I'm asking. It is very when we start solving question now, it is very important. So I need to know, maybe you on that. But if that's all you can say about it, it's fine, so that we can proceed. But if you still
yes,
think that you
yes.
can still say something, let me hear.
No, let's proceed though, or maybe Madam Diola will help me.
Okay, ma. Uh,
Let's proceed though. Don't ask.
we should proceed. You don't want
Yes.
to tell me. You don't want to tell me anything. No wahala, I will proceed with my wahala. So now, it is very important. That's the reason why I quickly throw in that question. Now, there is difference between both of them. Now, the difference is that this is an equity instrument, investment in shares, while this is a debt instrument, investment in bond. The difference is that in equity instrument, your return on that investment is not certain. And that is the information I'm passing. Your return on investment. What is the return on investment in equity instruments? The return is dividend, and that dividend depends on the profitability position of the company. If the company make profit, then that profit will be moved to retained earnings. Then that retained earnings, they will declare dividend. Then you collect the return on your investment. At the end of each financial year, you are entitled to dividend. Then this equity instrument, that is number one, you are entitled to dividend. Number two, this money, example, if you invest in these shares, let's say 100 million naira, e.g., let's say 100 million naira. So you see, this 100 million naira is Sokpoti law. Let me use Yoruba for the people that don't understand Yoruba. Let me use English. It is called "it don't go." This 100 million, that is the reason why shares is very, very risky to invest in. Very, very risky. This 100 million you invest, it is Sokpoti law, and the only way you can collect this your 100 million back is when you sell these shares, especially when the company is doing fine. That company is doing great. You can sell this your shares. In fact, you can sell it above 100 million. You can sell it 150. You can sell it 200 when the share has value. But if you are somebody that you are not very sharp, this 100 million, if the company collapse, low, this 100 million, low. And that is equity investment. It is a very risky investment. And that is the reason why when you buy shares, they are called the true owner of the company. If they ask who is the owner of the company, they are the equity shareholders. The equity shareholders, they are the risk taker. They are the people that are doing what? They are taking risk. If imagine investing 100 million and supporting law, you think about it again. So this 100 million naira, if you did not sell these shares, this 100 million can vanish vim. So the only thing you are entitled to is what? Is dividend. And that dividend depends on what? Depends on the profitability position of the company. That is equity instrument. That is the equity. But debt instrument is a loan. This debt instrument you are saying, it is a loan. So when you invest in this bond, and that is the reason why I said I asked that question. When we start solving question now, when you invest 100 million in bond, they will give you the maturity period. They can say 5 years, they can say 3 years, they can say 10 years. So the maturity period let's say maturity period is 5 years. What it means is that at the end of 5 years, you will collect your 100 million back. You will collect your 100 million at the end of the maturity period. You will collect it back. And when you collect it back, it can be in 3 ways. It can be in premium, it can be at par, and it can be in premium, it can be at par. At par is that you invested 100 million, you collect 100 million back. At premium means you invested 100 million, you can collect 120 or 110. Then at discount is that you invested 100 million, then you collect 90 million, but you collect your money back. And that is why these people, the debt instrument holders, they are not the owner of the company. They are just the creditor of the company, because they are granting loan to the company. This is a loan. This investment in debt is a loan, and it has two characteristics. At each year, you will be collecting interest. So when we start solving question now, you will be seeing it. You will be collecting interest every year, or it depends on the contract. It can be half yearly, it can be every year, but you will collect your interest. In fact, the interest is fixed. The interest is fixed. You'll be collecting your money. And at the end of the maturity period, you collect your 100 million back at par, at premium, or at discount. That is debt instruments. But equity instruments, it is a very, very risky, and they are the owners of the company because they are able to take risk. So what do? They make sure the company is flourishing very well. And those are the people that participate in the business. And that is why we have associate. If you remember very well, I said associate too. When we are solving associate question that time, you will be collecting you are entitled to retain earnings of the company because you are the one that take risk. And these two, can we see the characteristics of the two? So when we are solving question, you know the reason why I explain both of them. So before we proceed, hope we now have a little insight about these two of them now. Before we proceed. Okay. So let's go now. Let's go. Let's go. Let's go. Mr. Adiola, how far?
Yes, sir.
Okay. Oh yeah, let's go. Now we have investment in treasury bills. Treasury bills is a debt instrument too. So when you invest in treasury bills, we have bond, we have treasury bills, we have debenture, we have the likes. All of them are debt instrument. It is only shares, investment in shares, that is equity instrument. Mr. Folashade,
Yes, sir. What's the difference between bonds and treasury bills?
now the difference is that bond is um treasury bills. Let me pick treasury bills first. Treasury bills relate to government. It is only government that sells treasury bills. So when you hear they are investing in treasury bill, it is government. Although bond too, government send bond too, they sell bond too. But the difference is that treasury bill cannot be sold by an individual. It is only the government that sells treasury bill. So as a company, if I need money, I go to the capital market. I can say that I want to issue out bond to the people, to the general public. Then they will subscribe, then I will collect money to finance my business. But I can, as an individual, I cannot issue out treasury bills. It's only government that issue out treasury bills. So that's just the difference. All of them, they are debt instruments, and they are going to give you your certificate. They will give you your share certificate, your treasury bill certificate that shows that you invested in that financial instrument. So hope you are fine, ma.
Yes, I am. Thank you, sir.
All right. So we have lease receivable. So another one, we have lease receivable. Lease receivable is a financial asset because it is a contract that gives the holder lease. You are expecting your lease rental. Every year you'll be collecting your lease rental. Then to the other party, it will be lease liability. So he will be owing, then you will be. So this is lease receivable. Lease receivable is also a financial asset. So proceed. Let's proceed. Let's proceed to the next one. So the next one is financial liability. So financial liability is the opposite of financial assets. Financial liability is the opposite of financial assets. And when question comes, and that is where problem will start. If you don't understand them very deeply, you'll be seeing that, is this question financial liability or financial asset? It is the opposite. Look at the definition. These are contractual obligation. It is an obligation. It is something you must do. It is something you must do. Financial liability is an obligation. To do what? To deliver cash or another financial asset to another entity. Can we see now? E.g., issue of shares, issue mhm, issue of, let's say, bond, issue of bond, issue of shares, issue of bond, issue of shares, etc. Now, can we see the difference? When we are talking about asset. What are we saying? Investment in shares, abi? Investment in bond, abi? But when we are talking about liability, what are we saying? Issue of shares, issue of bond. What it means is that when we are issuing money, what are we doing? We are collecting money. Whenever, and this is how it works. Financial liability, we need money. In my organization now, I need money. And if I need money, what am I going to do? I have the let's say I have the option to issue out bond. So if I issue out this bond to the general public, I will say, people, Mr. Folashade, Mr. Diola, Mr. Peter, I am issuing out bond though. If you have money, come and buy bond though. So what are you going to do? You are now going to buy my bond. So when you buy my bond, in my financial statement, it is a liability, it is a financial liability. It is a financial liability. It means I am owing you. Then we will now talk between each other. I'll now say, you now ask me that, Mr. Taufik, what is the maturity period of your bond? I'll not, it is 3 years. So then Mr. Folashade will now say, okay, I want to buy 50 million bond. Then I will collect 50 million naira from your hand. I will give you bond certificates. Then Mr. Adiola will come. When is your maturity period? 3 years. She bought 50 million too. I collect it. So in my financial statement, it is a liability. It means I am owing both of you money. So it is a liability. It's called financial liability. Because in 3 years' time, I must return your 50 million. I must return your 50 million to you. And apart from that, at the end of each year, I will give you your interest. I must give you your interest. So whenever you see bond, you see there is one characteristic in bond. They call it issue of 10% bond. There is usually a percentage beside that bond. Like this bond I put here, I forgot to put it. They can call it 8% bond. So that 8% is the interest you'll be collecting every year. Every year you'll be collecting 10% on that bond you give me. Then at the end of the maturity period, I'll now return your 50 million. So the difference between financial asset and financial liability is that financial asset is it is an asset. It is an asset. While financial liability is I'm owing you, and that is how it works. Then financial liability, then we have issue of shares. So when you have issue of shares now, and that is where we are going. This issue of share, let me now highlight it as read. Issue of shares is not a financial liability. Let me quickly say that. It is not a financial liability. It is an equity. Because when I issue out shares to Mr. Adiola and Mr. Folashade, I'm not giving you back. I'm not giving you back. And that's the difference between issue of bond and issue of shares. This 100 million, this 50 million, I will not give you back. What am I going to do? I'm going to bring both of you to my company. Then you now become a shareholder. So when you issue out shares to the general public, you are telling them to have a controlling interest in your entity. So it's either you are an ordinary shareholder, an associate. Then if that money is too much, you can control my business. So that is it. I have a question. Oh yeah, you can go ahead.
So, but I can sell my shares in that company to another person.
Yes. You can sell your shares. Yes, you can sell it. What's your question, ma?
That's what I just want to clarify. Since you said it's not a liability because you are
Yes,
not receiving your money back at the end of the
yes,
day, you just probably profit and dividend you'll be receiving
yes.
from
It's
whatever you've
yes.
invested.
So when you sell your shares to me, it means you are giving me ownership interest. You want me to be part of your
Mm.
business. So I will now become your associate or become an ordinary shares, or I can even control your business if I have more than 51%. So that is the difference between issue of shares and issue of bond. Issue of bond is a financial liability. So we are fine, Abi. Oh yeah, let's go then. Let's go then. Contractual obligation to exchange financial assets or
So why
financial
do you
liability
put
under
it there?
condition.
Erica, remove it now. This issue of shares, why do we put it in that definition?
Oh yeah, let me put it. Let me remove it later so that during your revision, we're not going to put it there. Let me remove it. So I can only put. Let me remove
Thank
it.
you, sir.
Yes, let me
Thank you,
remove.
sir.
Mm. Issue of 8% debenture. That's another example. So issue of 8%, that is a financial liability. That is a financial liability. So those are the example. Issue of shares is an equity, not a financial liability. So contractual obligation to exchange financial liability. So that is the opposite of financial asset. You also have an option to exchange that financial liability under the condition that are potentially unfavorable. This with derivative. We will come to this also include a contract that will or may be settled with entities own equity instruments. So these are just the definition. Now, example of financial liability. We have trade payables. Can we see now? Trade payables. Oh, where are we going now? Today. Okay. Trade payables. Can we see now? The opposite of trade receivable is what? Trade payables. And what is trade payables? When I'm owing my creditors, when I'm owing my supplier money, and it must be settled within 1 year, it is trade payables. Bank loan. When I go to bank, I go and collect loan from bank. It is a financial liability. Redeemable preference shares. Redeemable preference shares. So we have two types of preference share. We have redeemable and irredeemable. So let me put it here in case we don't know what the exam can say. Let me put it here. Notes. Irredeemable preference shares. Irredeemable. Irredeemable preference shares is an equity. This is an equity instrument. Let me put it in that way. So we have redeemable and irredeemable, Abi. So redeemable preference shares, it is a preference shares that you must redeem. That means you must repay it. And when you repay it, that is a loan, Abi. That means it is a loan. But irredeemable preference shares, it means that what? It means you are not repaying that loan. Or we can say you are going to redeem it, but you don't know when you will redeem it. And that is why this one is an equity. So any instrument, any investment that you collect that you are not going to repay, it is an equity instrument. Shebi we remember investment in equity instruments. You cannot collect your money back. Hope this one is somehow fine before we move on. Okay. So bank overdraft is a financial liability. Bank loan notes, all these things are loan, all these things are financial liability. When you have a loan note, they will just give you a certificate like this that you are owing, the company is owing you. In the next 5 years, they will repay you. It is a called loan note. It is called loan note. Then we have lease payable, the opposite of lease receivable. Then we have debenture. So these are all financial liability. So that is why I put irredeemable preference shares. It is an equity instrument. Now, the first the first calculation we are now moving before we move to first one, Let me quickly talk about derivative financial instruments. So IFRS 9 also talks about another instrument called derivative financial instruments. I even thank God that we have done, most of us have done SFM. If you remember SFM, you will remember all these forward contracts, future contracts, interest rate swap, options, abi. Should we remember them very well? They are in finance, in IFRS 9 context, they call it derivative financial instruments. And what is derivative financial instruments? These are financial instruments that has the following characteristics. Number one, the value changes in respect to the value of an underlying asset. Number two, it has no or minimal investment, then it is settled at a future date. Now, let me quickly bring this derivative financial instrument down. Now, in life, we have some fluctuating assets. We have some fluctuating variable. Example is foreign currency. We all know, we all hear news in Nigeria now that dollar today is 1.5, but tomorrow we just hear it in the news. Dollar is now 1.6. Wow. Tomorrow, pounds is now 2,000 something. So foreign currency, it fluctuates. Now, where does derivative financial instrument comes in? It is a financial instrument because it is a situation whereby you now enter into a contract with another person. That person, you can call it a dealer, it can be a bank, that next month, I want to buy $2,000 because I want to settle one money. I want to settle one payment in US. So I need $2,000. Now, as at today, let's say the dollar is 1,005. Now, let me ask that question. As at next month, is it possible that dollar will remain 1.5? Is it possible? That dollar next month, is it possible?
No.
Thank you, man. So it is very impossible to do what? For that dollar to remain 1,005. It will either increase or reduce, abi? Yes.
Yeah.
Now, yes, if it's either it reduces or increases. Now, that is where derivative financial instrument now come. You now go to bank, or there are some dealers that you now enter a contract with them that I want to buy dollar next month to $2,000. Can both of us enter into a contract, call forward contract, that next month you will sell dollar for me 1.5? Not talk less of what happen next month. Even though CBN announced that dollar is now 1.7, it does not concern me. Me, I say I want to buy it 1.5 next month in your own hand. I need that $2,000 and I want to buy it 1.5. Then the dealer will now say what? The dealer will now say, no problem. Oh yeah, let's enter into a contract. The dealer will now say, okay, per $1, can you give me 100 naira for $1? So for that $2,000, can you pay me 500,000 for that forward contract? That contract, it is different from that dollar that you want to buy from his hand. You know, you buy that $2,000 from his hand. That contract that you want to buy that dollar at that 500, that 1,005 per dollar. That contract, you now enter a contract with that person. You now negotiate the price. The person can now say, okay, oh yeah, give me 500,000, because that person is taking a risk. Because in the next month, dollar can increase, and if dollar increase to 1.7, you will be at advantage because you have entered into a forward contract and you have hedged that risk. That is what they call hedging. Hedging in IFRS 9, they call it hedging. You have hedged that risk, and that is what big companies does now. All those multinational companies, they enter into hedging transaction. to hedge risk, because all these foreign currency, they are risk. So one of it is forward contract. So I will now enter into a contract with you. Please, I want to buy $2,000 next week at 1,005. How much are you going to? How much should I bring for us to enter into that contract? That person now charge you 500,000. So that 500,000, it is called premium, or it is called minimal investment. So in my financial statement, I will now value uh that contract. I'll now call it financial asset. That is derivative financial assets. It is called derivative financial assets. So in the next month, when we now settle that transaction, I'll now derecognize it. I'll derecognize that financial asset, that contract. I'll do that. I'm doing it. So there are types of derivative financial instruments. We have forward contract, we have future contract, we have interest rate swap, whereby we swap interest rate, then we have option. So that is derivative financial instrument. I know I will have question. Mr. Folashade, Mr. Adeola, do you have any question for clarification so that we can move on? Hello.
Hello, sir. I don't have any question. You can move on.
No, I'm fine, sir.
Oh, that forward contract, you understand that contract, Abi? For me to hedge that risk in the future. Yes. So that is derivative financial assets. So in ICANN, let me just add this. In ICANN setting, derivative financial instrument is in IFRS 9, but it has never been tested. It has never been tested. And that is the reason why, even when I was doing my ICANN, my lecturer don't have time to teach me this derivative financial instrument, because I can have never, like, it is just inside the study pack, but because it is complicated. In fact, if you can't find somebody that will explain, that will break it down to you, you cannot understand it. It is very complex. Hedging and derivative financial instrument, very, very complex. So I don't usually test it, but I just look at it now that we are going to SBR now. You know, SBR, we see how it's now SBR. We don't know what those ICANN examiner can say. They can test 5 marks now. For what they can just say anything so that we can say something on it. That is the reason why I just make mention of it. Hedging and derivative financial instruments. It is in ACCA. It is very, if you are, when you are going to exam, if you don't know this one, let's say you are just wasting money. So it is in ACCA that is very, very important. So let's move forward and let's pray it will not come out, because it is very, very complicated. Very, very complicated. So yeah, let's move on. Let's move on. Let's move on. Let's move on. Now, compound financial instruments. Compound financial instrument. That's where we are going to now. Compound financial instruments. So this is a financial instrument that has the same, that has a characteristic. That means they contain both equity components and liability components. And this is our first calculation for today. In fact, it came out last diet, and that's the reason why I sent that question to the group. What is this one again now? So, compound financial instruments. I don't know, Mr. Adeola, Mr. Folashade, have you seen anything like this before? Convertible bond, convertible loan note, convertible debenture. Have you heard about? Have you seen anything like this before? Convertible bond. Have you heard about it before? Convertible loan note, convertible debenture.
Yes, in SFS.
In SFM.
Okay. That, so in IFRS 9 context, they call it convertible, they call it compound financial instrument, because they have the characteristics of both equity and liability. Now, what is convertible bond? You know, bond naturally is a financial liability, it's a loan, Abi. Now they now call it convertible. That means you have an option to convert that bond to equity. And that is why they call it convertible bond, convertible loan note, convertible debenture. So they are called compound financial instruments that has two characteristics of both equity and liability. Although naturally they are liability, but you have an option to convert it to equity. So it depends on you. It depends on the holder. If you are an holder that can take risk, if you are a risk taker, a high risk taker, you are going to buy convertible bond in the sense that that company can be very, very lucrative. If that company is very, very good, it is good to buy convertible bond. So at the end of the third year, instead of you to collect your loan back, what are you going to do? You are just going to convert it to equity shares. Then you become the shareholder of the company. And that is compound financial instrument. Then what does IAS 32 say? So IAS 32 is the standard that discusses about compound financial instruments. It is IFRS 32. And what does IFRS 32 says? It says it requires that compound financial instruments should be separated. So whenever an entity acquire a financial instrument, a compound financial instrument, or issue out compound financial instrument, it must be separated into equity and liability using a method called split accounting method. So there is a method in IFRS 32 called split accounting. So that split accounting is used to split compound financial instruments into the liability and equity part. So, and that is what we are going to, the first thing we are going to do today, although the question came out last diet, but it's not of calculation. So it is, let's say, written. So let's solve this question before we now move to the next one. Now, there are steps in separation. How do we separate it? Number one is to determine the contractual cash flow. What is the contractual cash flow? When you buy a financial liability, you are going to be paying interest and you must redeem that money. That means redemption value. At the maturity period, you return the money to the person that buy it. That is redemption value. Then we discount it to present value using effective interest rates. So all these steps, we can actually understand it when we start solving question. If we don't solve question, all this story, I'm not sure it is going to make sense. The stories, they are not going to make sense. Now, oh yeah, let's check our group. I've sent the question to your group. Let's check our group. Let me present it here because and we are starting now. This stupid Excel will not open. Don't worry, I will share my entire screen so that we can solve it together. So let me present the question now. Let me present the question because we'll be fighting this Excel now. So this is the question. XYZ Limited issue 10 million 5% convertible loan note. Now, the first question I want to ask, is this a financial asset or a financial liability? XYZ issue 10 million 5% convertible loan note on 1st January 2021. So is this a financial asset or a financial liability?
So it depends on the side of where we are looking at it from.
Don't look at it from any side though. Don't look at it from any side. And that is the reason why I said financial instrument is
Financial liability.
It's financial liability.
yeah. Why is it financial liability? Why?
Because it's loan.
It's a
Loan.
loan and they have liability or obligation to pay it back.
Okay. But in this question, okay, they told us that convertible loan note. But this convertible loan note can also be an asset now. It can also be an asset. Can you see how it is complicated? That is why I find it's very, very complicated. Now let me
Because
quickly. Okay. Oh yeah, talk.
because at that time they are receiving is like, no, but is that an asset? To them is a liability now.
Now look at it now. This is what makes it lab. You both are correct, 100% correct. But this is what makes it liability. This English, this verb, XYZ issued, and that is where I'm going. You must put your eye on that English. Is either XYZ invests or purchase or issued. So if the question says XYZ purchase 10%, 5% convertible loan, it's not a liability again, no, it is an asset. Oh. If XYZ purchase or invest, it is a financial asset. But if XYZ issued, it is a financial liability. So this question is a liability question. Any question for me? Eh?
Not at all. It's understood, sir.
Understood, Abi? Mr. Adiola, how far?
Yes, sir.
Okay. All right. So where is that
Yes,
question?
question.
Okay. Okay. So is that question you are going to be putting our eye on? You put an eye on that question. Is it issued or purchase? If it's purchase, is asset. If it's issue, is liability. So this question is a liability. So they said XYZ issued 10 million 5% convertible loan note. So this 5%, what did I call it that time? This 5%, what did I call it? That 5%.
Premium or discount, Abi?
Is that what I call it? Hmm. That's not what I call it. Oh, what did I call it? We did not remember again. There's no problem.
Sister Aderemi, please help us. Adiola.
I'm not sure. Is it that interest or coupon?
It is interest.
Okay.
That is your interest. So in this contract, the amount you will be receiving every year, it is this 5%. They call it coupon or interest in your
Okay.
SFM. So
Yeah.
the amount you'll be receiving is this 5%. And usually beside that loan, anytime you are issue out loan, there must be this percentage beside that loan. If it's bond, they will put 8% bond. If it's debenture, they will put 10% debenture. It must be, they must put it there because it is fixed. This money, they must collect it. So on 31st December 2023, this will either be repaid at par or converted to shares on that date. Can we see now? On December 2023. So what is the maturity period for this loan? Let me ask that question. What is the maturity period for this loan? The maturity period for that loan, what is it?
3 years.
3 years, Abi?
Yes.
So from January 2021 to
December.
December 2023, it is 3 years. So that is the maturity. So at the end of 3 years, we must return that 10 million naira to the owner. And that is what they are saying. We must return that 10 million naira to the owner. And that is what we are saying. You know, it is a financial liability. It is a financial liability. So this is what we are going to do. So what is the requirement? Oh yeah, let's finish this quick. Time is going. Financial instruments. Okay. This will either be repaid at the end of the third year or converted to shares. Can we see that? That's why they call it compound financial instrument. The interest rate for loan notes without option to convert is 8%. This is the effective interest rate. So when we are dealing with Ifrs 9, there's something they call effective interest rate. This is the rate that is used to acquire loan in the market generally. It is called, it can also be, this effective interest rate, it can also be called rate of return, in which a company can use to collect loan from outsiders. So it is usually given. It is called effective interest rate. It is called effective interest rate. So this rate is very, very important to us too. Very, very important. Very, very important. So now, in year one, what are we going to do? Now, to now split this financial instrument, to split it, please, this question, have you seen it in our have you seen it in our group now? The question.
Yes.
Okay,
Yes.
because I will unshare my screen now. I need to share my Excel so that we solve that question. I need to share my, okay. Let me share my Excel now. I will share my entire screen because that Excel, we remember it has problem. So I'm not ready for his problem today. So let me share my entire screen. Where is that Excel? So you are going to be giving me figure. So yeah, let's quickly solve. So this is the question. And this is how we are going to solve the question. So IFRS 9 says that we should split that compound financial instrument using split accounting, right? And this is what we are going to do. Determination of equity and liability components. Liability components using split accounting method. So this is the heading, and this is what we are going to do. How many years is the financial instrument? How many years is it?
3 years.
3 years. So what are we going to do? We are going to do it like this. I know we remember this step. We did it in list. We have year one, we have year two, we have year three. Now we have, what can we put here? Let's say details. Okay, let's put details here. So these details will be a little bit long. Then we have okay, we have amount. After amount, we have discount factor at, where is my hat now? It's not the first time I'm using hat now. At effective interest rate. What's our effective interest rate? At 8%. So that discount factor must be at effective interest rate. Then we have
Oga Taufik,
ma.
let me sound like Mr. the other man. Sorry that I'm taking you back home. So this question we are solving, sir, is compound financial instrument. It has both equity and liability.
Yes.
So what is the indication? I know it has liability. So what's the equity that is there now?
Now this is it. You know it is called compound financial instrument.
Yes.
It has both liability and equity. So
Yes.
now, since it's a compound, where are you going to put it? So that's the question. Let me ask that question. Where are we going to put it in our financial statement?
Where are we putting which one of them?
Now, you know, if it is a financial liability, example now, if it's a financial liability, where are we going to put it in our financial statement? You know, we will put it under non-current liability.
Under non-current liability, yes.
God bless you. Now, if it is a financial If it is an equity, where are we going to put it?
It will be under equity.
God bless you. Now, since it is now a compound financial instrument that has both equity and liability, so where are we going to put it?
I
So
don't
can you
know.
can you see that you could not answer the question?
No,
So
no,
now,
but my question is that how do I know that it has financial equity in this question now?
that is why I said it, that when you hear compound fine, when you hear convertible bond, when you hear convertible loan notes, when you hear convertible debenture, they are
Okay,
compound financial instruments.
okay.
When that name, that convertible, is beside it, so
Yes,
it is not a liability, it is a compound financial instrument,
financial instrument. Okay,
which must be split between, which must be split into equity
and
and
liability.
liability. So we must
Okay,
split both of them.
I
So
understand.
yes, so in year one, in the year one, you know that asset, that question, what is that question? They gave us 5%, Abi. How much is that loan? 10 million, Abi. How much is that loan? That money go in the question.
It's 10 million. I thought
10
I was
million.
talking 10 million.
10 million, yes. Okay. Major and center. Let me put workings here. Now, this is what we are seeing. In year one, I said year one to 3. You know, I said it earlier that you are going to be receiving money every year. Which money did I say you'll be receiving every year?
The interest,
The interest, Abi. So how much is the interest? Interest.
5%.
So 5%. So 5% of 10 million naira. What is it going to give us? $500,000. Abi?
Yes, 500.
10%. So it will going to be 500,000.
Yeah, 500.
So the interest we will be collecting every year is 500,000. So in year one, we will collect interest. In year one, we will collect interest. So what should I do? Let me hang my 1,000. Let me hang this. So this should be, let me copy this one to like this. So in my year one, how much will I collect? 500,000. Abi? Now, then in the question, they now give me what? They gave me, okay, I'm even sharing my screen. That is fine like that. Where is this this is my question. Now they now give me discount factor, Abi.
Yes.
So should we remember in SFM, this discount factor, they will not give us, we are the one that will find it though.
That
Abi?
work it out. Yes.
That one all over 1 plus r raised to power minus n. That's how you, so this 5% is a trap. We don't need it. This 5% discount rate that they give us, we don't need it. It is the 8%, which is the effective interest rate. So this is discount factor we need, Abi. Oh, I cannot copy all this thing. That's what the exam has. If he has, okay, maybe you give me all of them. So I need a discount rate of all these. What is the second one, please? Please, maybe you can give me.
Okay, second one, 0.857.
857. Then third one,
0.794.
794. So this is the discount rate. So in year one, I'll collect 500,000, which is my interest. You know, this interest, I'll collect it for 3 years, Abi.
Yes.
So in year two, I'll collect my 500,000 too. In year three, I'll collect my 500,000. So I'll collect 500,000 year, then I'll collect it year two. Now, in my third year, you know, I asked a question when we are solving. I said, how many years what is the maturity period for this convertible loan? And we agree that it is 3 years, Abi.
Yes.
So in my third year, I will collect two money. I will collect interest, then I will collect redemption. Redemption is my money. I will collect my money back. How much will I collect back? I will collect my 10 million naira back. So what will be the discount rate for this third year? It is copy and paste. Please don't let us do mistake. That's the mistake some people do. They will now think this one is for year 4. They will now go and put discount rate for year 4 year. No, it is 3 year. It is 3 year. And for professional level, I just did this thing like this so that in case skill level 2, they can watch the video. That's why I separate it. For professional level, I can do it like this: interest plus redemption. I'll just say interest plus redemption. In year 3, I will collect interest plus redemption. So this place will now be 10.5. But let's leave it like this. But we should be very conversant of this discount rate though. It must be the same because it is year 3. So, oh yeah, let me use Excel. So my amount multiplied by my discount factor. So it's going to give me all this. So I can drag down. So can you see now? My present value, I'll discount all these things using the effective interest rate of 8%. I'll drag it down. So then I'll take the total. What is the total? So the total is 9228.5 Abi. So this is my liability component. This is my liability component. So in my financial statement on 1st January, this is what I will put as my financial liability. Please, are we here?
Yes, I'm very much here, sir.
Yeah. So for that convertible, that convertible bond, is it bond or loan notes? We said it comprises of convertible and equity, Abi, and we must split it into equity and liability component. So this is the liability component. This is the liability component. So to get our equity component, this is what we are now going to say. How much is that money gone? The total figure, total value of, is it bond or loan notes?
Loan notes.
Okay, total value of loan notes. The total value of loan note, how much is it? 10 million, Abi?
10 million, yes, sir.
It is 10,000. So our liability component is going to be 10 million minus that liability component.
Wow.
So that is our equity component. So what are we going to do in our financial statement? This is what we are going to do. So since we are issuing, let me put the journal entry for this transaction now. This is going to be the journal entry. So since we issue out this loan note, are we going to collect money or we are going to give money? Let me ask that question. Are we going to collect money or we are going to give our money?
We are collecting money.
We are collecting money, Abi. So in our financial statement, we will debit bank with how much? 10 million naira. We will collect 10 million naira. Now, what are we now going to do? We are now going to credit liability. What are we going to say? We call it financial liability. Financial liability. How much is it? 922,800. 9,228,500. So that will be a financial liability. Then this one will be equity. So that equity will be how much? This one, 772,000. So that is our journal entry on, let me put the date, on initial recognition on 1st January, on 1st January 2023. Is it 2023? 21.
2021.
Yes. So, please, what is the requirement, ma? What is the requirement?
Calculate the initial measurement on 1st of January 2021 and subsequent measurements on 31st of December 2021.
Okay. Now, this is the initial measurement. On day 1, when we buy that financial asset, this is what we are going to do. So let me now insert, let me quickly do the subsequent measurement. That one will not be very long. So subsequent measurement, we are going to subsequently measure it at what? At effective interest rate method of IFRS 9. Should we remember how we did list now? So subsequent measurement on 31st December 2021. So we are going to use effective interest rate method of IFRS 9. The one we did using when we did our list. So what are we going to do? We are going to have opening balance. I know we will remember now if I use it now. After opening balance, we have effective interest rate. How should we use it? Okay. Finance income. Okay. This will be finance costs. At effective interest rate, EIR. What's our effective interest rate? 8%. Okay. Then we have repayment. Then we have closing balance. So this is what we are going to do. Let me wrap this so that we can see it. Now, opening balance. What is our opening balance? This is our opening balance. This is our opening balance. Now, our effective interest rate at 8%. What are we going to do? We are now going to say 8% is 0.08 multiply by this opening balance. So that will be our finance cost. That will be our finance cost. Oh. Now, how much are we collecting every month? How much are we collecting or paying every month? Where is our workings? Where is that our workings? Maybe it's 500,000. So this one will now be 500,000. Do we remember this when we did our list? Do we remember this? What we did when we are doing our list? Then this will be our closing balance. So this is the closing balance of the financial liability in year 1. We have forgotten this. Okay, maybe if I add this, maybe you remember. So this is our A. Then this is our B. Then this is our C. Our closing balance will now be A plus B minus C. Do we remember? We do not remember this list. So A plus B minus C. So this is our financial liability as at December 2021. These are our financial liability as at December 2021. This one will be in year 1. Year 1. So in year 2, we'll bring this balance here again. We'll calculate 8% on it. We put it here. We deduct 500,000 again. We put it here. If we do this thing for 3 years, then this balance will be nil. This balance will be new. So this method, this is subsequent measurements. Let me put it. This method is called using effective interest rates. It is called effective interest rate method. Effective interest rate method. It is the subsequent measurement of financial assets or financial liability. So at the end of the financial year, this is our balance of financial liability. But as at that date, this equity will remain the same. There is no remeasurement of this equity. There is no remeasurement of this equity. This equity must remain. It must. We are not going to remeasure it. At the end of the year, 31st December 2021, this will be the amount. At the end of the year, December 2022, the same amount. At the end of year 3, the same amount. Then at the end of the year 3, if the person now wants to collect his money back, they will now recognize this equity. But if he says he wants to convert to equity, then we now recognize this liability, we now convert it to equity. So that is all about convertible loan. That is compound financial instrument. Do I have any question before we proceed?
Okay, so I don't have question. I just want to be sure of what you said. And I think I know it. So for if I'm doing for year 2 now, the closing balance will be the opening balance, then I'll do the effective interest rate on it. The 500 is
constant, very constant.
That's fine. I'm good.
Yes, in year 3 too. This closing balance here will be my opening balance. Then I'll do my effective interest rate. Then this is what we did in lease. Maybe when we do revision, you remember this is what we did in lease. That's how to measure lease too. Lease liability. That's how to measure lease liability. So that is it. So we are fine, Abi. Oh yeah, let's go. Time it is law. Audit law. Oh yeah, let's go. Did I present my Excel or I shared my entire screen?
You shared your entire screen.
Excel is showing.
So if I okay, let's go. It's my Excel I shared though. I did not share my entire screen. Like I was very surprised. If my entire screen, I will be seeing you like this. I'm out of the Excel like this. I'm out of the Excel. About Joe, we did not receive any message. You know, if it's my entire screen, I'll be receiving message. I'll be seeing hello, sir, from Ifrs group. Voila. Oh yeah, let's continue. Okay. Let's continue. So we are done with compound financial instruments. Let's move to next part. What did I present again like this? Okay, yeah, let's go now. Let's go. So we are done with the compound financial instrument. So all these steps that I said the other time that I was speaking English, I know it's not going to make sense. Can we see now? Step 1 says determine the contractual cash flow. That means periodic interest and redemption value. 2, discount the contractual cash flow to present value using the effective interest rate. Shebi, that's what we did. We discount all those 500,000. We discount it to present value using effective interest rate of 8%, Abi. Then step 3, the amount determined in step 2 represents liability component. Abi, shebi, that's what we did. Then the difference between the nominal value and the liability component is the equity component. Shebi, that's what we did. Then the equity component requires no subsequent measurement. That 772 that we got, it requires no subsequent measurement. and should be presented separately in the equity section. That is other component of equity. The liability component should be subsequently measured at amortized cost using the effective interest rate method. Maybe that's what we did, Abby. So that is the step. So in case we want to forget, in case everything comes, we can come back to this. We can come back to our steps. But that step, if you do not solve questions, it will be dancing. You know? So now let's go. Classification of financial assets. Classification of financial assets. Now, how do we classify financial assets? When we have financial assets, all these receivable, all these investment in shares, how do we classify them? So according to Ifrs 9, financial assets can be classified into three. It can be classified into three. Number one, financial assets at amortized cost. Sorry, financial assets at amortized cost, financial assets at fair value through OCI, then financial assets at fair value through P&L. You see this classification, please let's take note of them because question can come out in any of them. Three of them are different. The question of three of them are different. So we must take note of them. However, they are very, very simple. Very, very simple. Now, for we to classify as amortized cost or fair value through OCI or through fair value through P&L, there is a basis of classification. There is a basis of classification. Now, the basis of classification depends on two things. Number one, the business model. What is the business model? And contractual cash flow characteristics, which is CCC or SPPI tests. So before we can classify any financial assets, we must use these two bases as our means of classification. It is this basis we are going to use to classify our financial asset. Number one, what is business model? Now, this has to do with the intention of holding the financial assets. And it can be summarized as follows. Number one is hold to collect. Now, I made an example the other time that I want to invest in one company, First Bank. Now, I now invested, let's say 20 million in shares. Is it shares or bond? Let's say we invested 20 million naira in bond of First Bank. Now, I will now ask myself, what is my intention of buying that financial asset? What is my intention? One, did I buy that bond to collect, to hold to collect? That means to maturity. This maturity, maybe we remember what is maturity now. Hello, do we remember what is maturity?
Yes.
That means if that bond will last for 3 years, so at the end of the 3 years, I will collect my money, Abi.
Yes, sir.
Okay. Now, hold to collect means that I buy that bond in First Bank so that at the end of the 3 years, I will collect my money back. And on a yearly basis, I'll be collecting interest. So that is hold to collect. So I will say my business model is to hold to collect. That means keep or hold the financial asset till maturity. Then number two is hold to collect and sell. Now, this second model is that I bought that financial liability to hold it till maturity. However, if there is a favorable opportunity, I can sell it. That is what they call hold to collect and sell. It is a true business model characteristics. Although I buy it to hold it till maturity. Example, I bought that financial asset, Egole, I bought it 20 million naira. Mr. Folajaye now said, Mr. Taufik, Sell these shares for me now. And I say, how much? Okay, I'll give you 40 million. And now you 40 million. I will sell you. I now sell it. So my business model is that I hold it to maturity. However, when there is favorable opportunity, I can sell it. So that is the second business model. Then the third one is to hold to sell. That means when I bought that asset from day one, my business model is to sell it. In fact, I did not even have any option. That I'm just saying I must sell it to. I must sell it. From day one, I've said my own intention. No, my intention. That is financial assets for us and financial liability. When you buy it on day one, you must have an intention. And that intention must not change until the end of year one. You can now change. So when you change it, you now reclassify that financial asset. That's what the standard says. Immediately you change your intention, you will classify it. But at the beginning of the contract, you must identify your intention. So these three are the business model. Now, contractual cash flow characteristics. Now, contractual cash flow characteristics. This consists of whether cash flow, the agreed cash flow or contractual cash flow is to be received through the maturity period, consists of principal and interest only. And that is where we are going. Now, there is something I quickly want to say so that it will be very, very fast. There are some financial assets that will fail this test. Example is equity instruments. Now, let me ask question. I want to ask question now. Mr. Folashade, Mr. Diola. Now, if I invest in shares of an entity, will I collect my principal and interest? Will I collect my principal and interest?
No.
I will not. Which one? What will I collect?
You will not collect principal. You can collect interest as a form of dividend.
God bless you. God bless you, man. God bless you. Mr. Adiola, you agree with that, Abi?
Yes, sir.
Oh, God. So that is it. So this contractual cash flow characteristics.
This is why you are gingering us.
Yes, now. I must
ginger you.
No, I trust both of you. You know, I trust both of you, except if you forget. But I know you remember. But don't worry, I trust both of you. So what we are saying here is this contractual cash flow characteristic. What it is saying is that contract, does it consist of principal and interest only or not? Now, what they are saying in essence is that there are some financial assets that will fail this test. You know, there are two tests. Number one, business model test. That one is simple. It is the intention that you are buying that financial asset. But this number two, there are some financial assets that will fail it. Example, and a good example is equity instrument. So equity instrument does not involve principal. You cannot collect your principal back. Otiloni, you don't go. But you can collect your interest back in form of dividend. So that is it. Now, base of classification. Now, yeah, let's go. We have understood the two tests that we talked about. Now, what is the basis of classification? Number one is measurement, financial assets measured at amortized cost. So when do we measure any financial asset at amortized cost? We measure that financial asset at amortized cost when the business model is to owe to collect. Can we see? When the business model is owed to collect, whenever our business model is owed to collect, and the contractual cash flow characteristics contains only principal and interest. That means SPPI test is passed. So when SPPI test is passed and our business model is to hold to collect, we will classify at fair value at amortized cost. Is that is noted, Abi? Whenever these two things happen, that financial asset must be classified at fair value, measured at amortized cost. Now, number two, financial asset measured at fair value through OCI. Now, financial asset classified at fair value through OCI is that if the business model is to hold to collect and trade if favorable condition arise, then the contractual cash flow is passed. Can we see the difference between number one and number two? Number one, the business model is to hold to collect. That means I invest in bond today and I intend to collect my money at maturity. Favorable condition happen o, it does not happen o, I'm not selling. So I must measure at amortized cost. But if I have the intention that I want to hold to collect o, but if Mr. Folashade come that he want to give me double amount, I will sell o. That means I will measure at fair value through OCI. That means I will measure at fair value through OCI. Can we see it is straightforward if we understand that English very well? When my business model is to hold to collect and sell, then my contractual cash flow characteristics is passed. I will measure at fair value through OCI. Then the third one, fair value through P&L. That means when my business model is to sell or trade the financial assets, then the contractual cash flow does not involve principal and interest. Then I will classify as fair value to P&L. So that is the basis of my classification. So the three of them, that is it. That is it. That is it. Do I have any question? Yes. I know I will have question. Oh yeah, what's my question?
Okay, I don't have question. I just want to say thank you, thank you, thank you.
Yeah, well,
Because this thing, it's normally even the lecturer that taught me last, the person cannot explain the difference between this OCI and P&L properly. And you brought clarity to it. I just feel like hugging you now. Thank you, sir. God bless you.
Amen. No problem. You are welcome. You are welcome. Actually, it is financial instrument is a very complicated. In fact, people usually sleep when they are teaching. It is very, very complicated. But you need somebody that is good in explanation and I understand it for you to explain. And that is it. So you are welcome, ma. You are welcome, ma. Miss Adiola, any observation and question for me?
I don't have much question, but they set it last night, question 5.
Yes.
So if you can explain that question, like how to understand it, everything in the
In fact,
question, then we will now continue to
yes, you
do
can.
this.
No problem. No problem. You see, I've sent the question to your group. That's the question we want to solve. Maybe that's that question number 5 that I sent to your group that we want to solve. But looking at this time now, yes, I've sent it to your group. The question, that's the question we intend to solve. Then that question is very simple. In fact, maybe if we did this lecture last night, maybe both of you would have, everybody would have passed SCR now. Because that question, this is it. But the problem of FIS 9 is that it is very, very complicated. It's very, very complicated. Else, if you see somebody that can break it down. So thank you very much. So, but there is a question I want to ask you. I was thinking one of you will ask. So now I'll now ask both of you. Now, assuming my I have a financial asset, the business model is to hold to collect. Then my SPPI test is failed. What would I classify it as?
Please repeat it again.
Mr. Folashade, are you here? Oh, I should repeat again. Mr.
Can you
Folashade.
repeat it, sir? Sorry, I was a little bit distracted. I'm not being sorry. Okay, I'm with you.
All right. I said, assuming my financial assets,
Okay.
the business model is to hold to collect. Then my
Okay.
SPPI test is now failed. What would I classify it as?
What failed?
The SPPI tests. That means the contractual cash flow does not contain principal and interest. That means I cannot collect my principal back. But I classify it as owe to collect. What would be my what would I classify it as?
Profit and loss. Yeah.
Fair value to profit or loss, Abi.
Yes.
God bless both of you. That is it. That is what I want to clarify.
I did not know why it is like that, though.
It's
Also,
showing now. Am I agree? That is what is showing on the screen now. The last one,
Oh,
number 3.
okay.
so that's the question I thought of that you asked, both of you asked me. Because sometimes
Hmm.
you owe to collect or owe to collect if you, but what happens when SPPI test is now failed? So the standard says whenever the SPPI test is failed,
Failed.
you must classify that fair value through P or L.
Yeah.
Okay.
You must classify as
Okay.
fair value through P or L.
Thank you, sir.
You are welcome. So that is just about that. But whenever it is passed, then look at it. Is it at amortized cost? Is it the business model? Is it owe to collect? Then classify as amortized cost. If it is owe to sell, owe to collect and sell, then I'll classify as fair value to P or L. But if the business model is to sell again, and that's another question I want to ask, but I know you get it. When my business model is to sell, but my SPPI test is now passed, please classify as fair value to P or L. When my business model is to sell, when it is to sell, you classify as fair value to P or L. So that is the classification that we talked about. So let's proceed. Measurement of financial assets. Measurement of financial assets. So how do we measure it? That means in our financial statement, how much are we going to put in our financial? That is our measurement. So at initial recognition, that means on day one, when we buy that financial asset, it will be measured at fair value. That means the purchase price. How much did we buy it? It will be measured at fair value plus transaction costs. Now, in financial assets, whenever you want to buy shares, there's one characteristic that is there, and it is very, very obvious. Now, let me ask you a question now. Mr. Folashade, Mr. Adeola, if you want to buy a share now, how will you buy it? Where can you buy it? Let me ask, where can you buy it?
Where can I buy shares? I will contact all these what's it called?
Stockbrokers.
All these stockbrokers. Yes.
Yes. So the money I will pay to my stockbrokers, that money that you pay to stockbrokers, it is called transaction cost.
Transaction cost.
So that is called transaction cost. So all financial assets, all of them must be measured at fair value plus transaction cost. Even though you give the stockbrokers 100,000 and you buy shares of 1 million, your total cost will be 1 million, 1.1 million. But you must add that transaction cost to it. But there is a condition if it is only measured at amortized cost and OCI. So if it's measured at amortized cost and OCI, we will add transaction cost to the purchase price, which is the fair value. However, when the financial asset is measured at fair value through P or L, transaction cost will be expensed. So we are not going to capitalize. When it is fair value through P or L, it is a must, we must expense the transaction cost in the P or L. So that is the initial measurement. On day one that we buy that financial asset, what do? We debit our financial assets, then we credit our bank because we paid money. We buy financial assets. So that is it. Now, subsequent measurement. What is subsequent measurement? At the end of year one. So at the end of the year one, if it is amortized cost, first one, our first classification is at amortized cost. It should be subsequently measured using the effective interest rate method. So what is the effective interest rate method? What we did now, Abi, that compound financial instrument, that subsequent measurement that we do, that we said A plus B minus C, that is effective interest rate method. So what they are telling us here, that when you have a financial asset measured at amortized cost, we must subsequently measure it using that effective interest rate. That is how we must measure it, using effective interest rate method. However, for fair value through OCI, we are not going to use effective interest rate method. We will measure at fair value. However, the fair value of that financial asset today and fair value as at tomorrow, it will be different. How? I bought the financial asset today, 10 million naira. Next month, that shares, it is going to increase or reduce. That shares must increase or reduce. If it increases, it might increase to 12 million naira. How much did I buy it? 10 million naira, Abi. Then as at next month, it has turned to 12 million naira. So the 2 million, it is fair value gain. They call it fair value gain. So as subsequent measurement, that fair value gain will be recognized in the OCI. And that is what we are saying here. Fair value changes, that means fair value gain or loss should be recognized in OCI. It should be recognized in OCI. That is what is here. Hope we get it. Can we move on? Hello? Yes. So that fair value gain, we understood it, Abi. That 2 million naira extra. At the end of the financial year, we must measure our financial assets. What is the fair value? If you now discover that, okay, it is now 12 million, so there is an increase. That increase is called fair value gain. But if it is a decrease, it is called fair value loss. So if it is at fair value through OCI, we will recognize at OCI. That 2 million naira will be taken to OCI. But if it is P or L, that 2 million naira will be recognized in the P or L. Will be recognized in the P or L. And that is the difference. So fair value through OCI, we recognize the gain in OCI. Then fair value through P or L, we recognize the gain in P or L. Should we remember PPE and investment property? Abi?
Yes.
Yeah. Revaluation gain in PPE, we take it to OCI, Abi. But
OCI.
yes.
Yeah.
For investment property, P or L, Abi?
It goes to P&L. Yes.
Yeah. That is the example I can cite for this financial asset. But at amortized cost too, we are not using we are using effective interest rates. We are using effective interest rate method. That one that we did now, A plus B minus C, that the opening balance. So when we solve question, we are going to see. So, and another thing that I need to say for solving question issue is the type of financial asset. I said it earlier, debt financial asset and equity financial assets. So all debt financial assets will be classified, can be classified as amortized costs, fair value through OCI, fair value through LPOL, depending on the business model, ABI, and SPPI test. But equity financial instruments, you can only classify them as fair value through P or L. Why? Because they will fail SPPI tests. All of them, all equity financial instruments, they will fail SPPI test. So invariably, they are usually measured at fair value through P or L, because you cannot collect your principal and interest, Abi. So they will fail SPPI test.
Okay.
So you
Oh,
are
yeah.
welcome. You want to say something now?
No, 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 no. I just want to recap something that you said, but you can continue. I'll do it when you are done, sir.
Okay. So equity financial assets is classified as P or L normally, Abi. However, there are some times and there are some questions. A company can make irrevocable election. So in practice, a company can make an irrevocable election according to accounting policy that this financial asset too, we want to classify it as OCI. So the standard give you permission to classify as OCI. So if the company make an irrevocable election, so a question can come like that they will say the entity make an irrevocable election to classify as OCI, then we will classify as OCI. And I put it again, lastly, equity financial asset is not measured at amortized cost. Just like I said earlier, we cannot measure equity financial asset at amortized costs. Why? Because it will fail SPPI tests. It will fail SPPI tests. So, oh yeah, Mr. Folashade. Okay, oh yeah,
Okay. Thank you, sir.
you are
So
welcome.
let me try and recap what you said recently. These measurements now, irrespective of the business model, the first thing we are going to do when we want to measure, we'll measure what's it called? At fair value. Please
Yes.
can you go back to that place now? I want to remember. I
Okay,
think I
sorry,
wrote
please
it down.
give me 1 second, please.
Okay, okay, sir.
Okay, Mr. Folashade, yeah, you can go ahead now.
Thank you, sir. So,
Alright.
you said at initial measurements,
Yes,
we measure it at
fair value.
fair value, irrespective of the business model. Oh,
Exactly.
we
Irrespective.
measure, okay, just fair value. It does not have
Yes.
maybe fair value at OCI, fair value at pay and help, but just fair value.
Now, let me quickly now talk now. That fair value is the purchase price. That is the purchase price. The amount you bought it.
Okay,
It
it's
is the
just normal calculation that the amount I bought it with the transaction cost, adding it
exact.
together. Okay, okay, okay,
Yes, purchase
okay.
price.
So okay. So then after that, then I'll now start using the normal then subsequent measurement. I'll start using the business model that we have
Exactly.
to
Exactly.
start. Then maybe it's going to be through amortization, through fair value
Fair value
OCI,
period.
or fair
Yes.
value P and L. Then you
Mm.
mentioned the last one. You now mentioned that equity, that financial instruments, equity financial instruments. It has to
Yes.
be through. It has to be through P and L.
Yes.
That's it. But
Yes.
now, maybe when we now see question, I'll now understand this financial, what's going between it and all this amortization, all these financial assets. So
Exactly.
maybe
It
when we
depends.
see question.
Is question. Is question. So now, classification of financial liability. Now, we know we are done with financial asset, Abi.
Yes, it remain
Now
liabilities.
let's move to financial liability. Now,
This is
financial
how
liability.
long ago? So how long? Okay, okay. Okay,
Hello?
that's it.
Are you saying something?
No. I said Ogun, say, as you said, that
Ah,
is a
financial
long
li-
story.
instrument is in fact we can use 4 hours, and that's why looking at it now, I think we are going to solve that question during revision. Mm. It will because
No
to solve
problem. At
question
least we
now,
have idea.
yeah. So we can now solve question. That last direct pass question is what we will solve during our revision.
Mm,
So at least we are fine now. So
mm.
now let's move to our financial liability. So financial liability can be classified into two: financial liability at amortized cost, then financial liability at fair value through P or L. Fair value through P or L. So financial liability does not have fair value through OCI. Please let's take note. Financial liability does not have fair value through OCI. It only has at amortized cost and at fair value through P or L. So, and we should take note again that financial liability, all of them are usually classified at amortized cost. All of them, all of them are at amortized cost. So, the only time we are going to measure at P or L is when we are expressly told that the financial liability is held for trading. When it is held for trading. And that's the difference between financial assets and financial liability. Financial liability, majority of all of them at amortized cost. Majority of them at amortized cost. So is that noted? Can we move on? Is that noted? Can
Yes,
we move?
yes,
Okay.
sir.
All right. All right. Let's continue. Now, measurement of financial liability, just like the same. All financial liability is measured at fair value, that is purchase price, less transaction cost. So if you remember, our financial asset plus transaction cost, but financial liability less transaction cost, less transaction cost. So however, when financial liability is measured at P or L, transaction cost will be expense. Shebi we remember this one, that whenever we classify at P or L, we usually expense, abi? But when it is at amortized cost, we capitalize transaction cost. but capitalization of transaction cost is less under financial liability. So hope that is noted. Hope that is noted.
Yes, sir.
Okay, yeah, let's continue. Now, measurement of financial liability. Just like financial assets, financial liability measured at amortized cost will be measured using effective interest rate method, Abi. Then financial liability will be measured at fair value. Then um, changes in fair value will be recognized in P or L. So that is it. Financial asset and liability measurement, their measurement is somehow very, very close. And that is the problem. If you can understand it, those concepts, their calculation is very, very simple. The only calculation that is complex in IFRS 9 is derivative and hedging. Those are the ones that is very complicated. But this financial asset, financial liability, like that last diet 15 marks they give you, is very, very straightforward. So, and look at it. Notes, loans, loan notes, debenture. Okay. Loan, this one is loan notes. Loan notes, debenture, or bond liability are usually measured at amortized cost, except otherwise stated. That means naturally, all those financial liability they are at amortized cost, except otherwise stated. And that except otherwise stated means that if examiner said they are for trading purpose, which is this, where we are expressly told that financial liability are held for trading. So financial liability, they are usually measured at amortized cost. And that is the end of the financial liability. So the rest are derivative financial assets and all this hedge accounting, which is not something we can discuss about. So are we fine now?
Yes, sir.
Okay. So that's all. That's what we can do into Mr. Folashade. So just like you
I'm here,
said,
sir.
so that's all for IFRS 9. So we are going to solve those last direct questions. Thank God I've sent it to your group. In fact, sending it to your group now. When you see the question now, I know you have idea now. As a last diet, it will be dancing. But when you check that question now, go and check it. You see that it's something I can do now because they ask just basic this financial asset and finance. That is the basic thing they ask. So that is it. But doing revision, we will solve all those questions. By the grace of God, we solve it.
Amen. Amen. Amen.
So that is it. That is it. That is it. So that's all. Let's
Okay, sir. I want to request that our revision class should be done in the morning. Oh, I don't know about, we can propose it, sha. You should start our revision class. They should not be in the evening. It should be in the morning time.
No problem. We are going to look at it now. We are going to look if in the morning is usually okay, so that in the morning we are done. So in the afternoon, night, all of us will be. We can now have our time. Then that is
revision and all those things.
no problem. No problem. That's fine. We'll look at it. We'll look at it. No problem. All right. All right. So
Esho, thank you. Thank you for making it looking so easy. I hope when we see it in the exam, it will be easy like this, like bread and butter.
By the grace of God, it will be easy.
Amen. Amen. Yes. Thank you. God bless you.
Amen. Problem, man. All right, ma. All right, ma.
All right. Thanks.
All right, please. Bye bye.
Bye bye.
Bye bye.
Bye bye.
Take care.